We appreciate that these are challenging times for everyone and are grateful that technology allows our business to continue to focus on delivering for our investors, including being able to connect with you like this when working remotely. Equity markets during the first quarter of 2020 were extremely volatile, and global equities ended down 9.3% in Australian dollar terms, with the FTSE Global Core Infrastructure 50/50 Index down a similar 9.7%. The fund outperformed both equity indices, ending down 8.8%. On a currency hedged basis, global equities were down 21.1%, the FTSE Index down 19.3%, and our fund down less again at 18.3%. We were pleased our tighter definition of infrastructure served the fund well during this period, being a major factor in our relative outperformance against the FTSE Index. The importance was even more pronounced when compared to the S&P Global Infrastructure Index, the other more broadly tracked industry benchmark, which we were more than 8% ahead of over the quarter. It was surprising that infrastructure as an asset class did not perform more defensively, as it historically has during periods of market weakness. In this case, there have been specific circumstances that have caused weakness in the pipeline and transportation infrastructure sectors. The social distancing requirements flowing from COVID-19 and the near complete lockdown of most national economies has had a direct impact on the daily use of transportation infrastructure assets like airports and toll roads. And whilst the North American oil and gas pipelines that we invest in have negligible direct commodity price exposure, the drop in oil prices as a result of the Saudi Arabia-Russia dispute, combined with the demand destruction from COVID-19, has been so extreme that it will likely cause second derivative impacts on the pipelines, including due to weakened credit quality of contracted shippers. Whilst airports are only 5% of our portfolio, they have been some of the most impacted. Airlines, and by association, the airports we invest in, are facing the biggest headwinds, who understandably have been subject to significant volume reductions, in some cases near 100%, with the majority of global airline capacity grounded. We have been stress testing our assumptions with a strong focus on the liquidity of balance sheets of airports and their airline customers, and have had more than 20 virtual meetings to dig deeper. Importantly, we remain comfortable with the liquidity of our existing investments. Notwithstanding the tough start to the year for markets, we remain confident in our strategy of investing in core infrastructure assets that possess strong barriers to entry and have strong strategic positions. Regulated utilities are one of the most defensive sectors that we invest in, and this has proven correct in the current downturn once again. We further rotated into some existing and new holdings during the period, and these assets represent by far the largest part of the portfolio at approximately 55%. It is extremely difficult in the current environment to have a confident view with regards to the outlook for markets in the near term. Valuations have certainly become cheaper, but the range of potential economic outcomes is unusually wide. Balancing those factors, we are now slightly more positive on the outlook for the listed infrastructure sector in absolute terms. What we do believe that we can be more confident about is that the defensive nature of the sector and our strategy should help provide investors a more stable earnings and cash flow outlook through the coming period of unusual economic volatility. Stay healthy, and thank you once again for your ongoing interest and support of our fund.